You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
A couple of the stalwart tech names reporting last night. Amazon, good quarter, stock up 6.5%. It's up very close, within a couple of dollars of its all-time high, and it is a 52-week high, but just a couple of bucks away from its all-time high. Meta also reported numbers. Stock's up 20%. This is $1 trillion market cap stock. It's not like a penny stock. This is $1 trillion market cap stock. No, and it's up 20%. So some real paper money's being made out there for some people. Let's break this stuff down. We can do it with two of our best at Bloomberg Intelligence. Poonam Goyal, she covers the retail business for Bloomberg Intelligence, and Mandeep Singh, supposedly a tech analyst. We'll see if he's got the goods here today. Poonam, let's start with you. Amazon, it seems like the consumer's in pretty good shape. What'd you hear from Amazon last night?
Yeah, thanks, Paul. The consumer is in excellent shape, and that's part of the strength that we saw in holiday. So the 9% online sales gain that you saw come from them and 20% in third party was pretty impressive, and actually probably the best in a few years since after the pandemic. So clearly a sign that the consumer has the funds to spend. But I'd say it also means that the consumer is choosing Amazon to spend their funds there. I think that's very key, as you will see some losers still coming out of the holiday season. But online is gaining traction, and Amazon is what comes to mind when you want to shop online.
Sure.
So what I found to be really fascinating, it was like a nugget, I forgot what research report I read it in, but that the cost to serve a customer's order fell by 45 cents a unit last year. How big a deal is that, and how hard was it to get there?
So Amazon doesn't disclose how many units they sell, so it's kind of hard to back into that. I'd say it's still a fairly small piece of the cost base, but what I would say is what's going to help them to continue to drive these costs down is just the efficiencies that they've created within their fulfillment network, right? You've heard them talk about getting packages to customers faster, and that's really a function of how they centralized their shipping and distribution networks. And we think that traditionally, when you hear about things coming to you faster, it's usually more expensive. And in the case of Amazon, it's actually cheaper. So it's pretty impressive, and it's all driven by scale.
The trucks are everywhere. I mean, it's just amazing. They got to be the biggest trucking fleet in the country. I don't know. All right, let's bring in Mandeep Singh here. Let's get to the technology aspect of Amazon, which has really been the driver of its profitability, and many would argue the stock price performance. Mandeep, what did you hear from Amazon last night about its cloud business, AWS?
I mean, look, I think when you compare it to Microsoft Azure growth, the growth is still kind of far weaker between the two. But Amazon is, much higher run rate, a $97 billion run rate. So they clearly seem to be stepping up in terms of their generative AI exposure, and they've given investors hope that they will be able to catch up. But look, overall, I think profitability-wise, they seem to be doing very well on the AWS front. Ad business continues to work very well for them, 26% growth. So Amazon, I think the diversification play they have and the fact that they seem to capitalize on any new trend, seemingly fast, even though in this case, Microsoft Azure clearly still has the strongest momentum when it comes to generative AI.
What I also found really interesting, Mandeep, is that with Amazon and even Meta, they're spending more, but the market feels okay about that. I saw the same thing with Exxon too. They're spending a little bit more, but their market's okay with that. What do you make of that?
I mean, look, when Meta is growing at over 20%, nobody cares about the Reality Lab losses. So
Fair
even
enough.
if they're losing $18 billion a year on Reality Labs, it's okay. They get a pass. The moment that growth tapers, and we saw that in 2022 when they had those negative quarters, everyone, started to complain about, how irresponsible management was in betting on metaverse. And yesterday, there was not even a mention of Reality Labs, given, the beat and raise and the fact that they really seem to be executing very well with 25% layoffs. So it all comes down to your top line. And if they keep executing the way they did last quarter, I think people don't mind the CapEx. And generative AI CapEx actually is a trend that we are seeing across the board from hyperscalers. So what we heard last night was Meta does have a generative AI play. It may not be on the cloud, but they are deploying their AI assistants everywhere, and that seems to be helping engagement.
Hey, Poonam, give us this update on the advertising business for Amazon, because I think that's a business not enough people pay attention to or gets enough credit, because there's some big numbers there.
It is. It's actually at a run rate of 60 billion now, and we think it can get to 100 billion by 2028. So clearly great growth there. And what you have to remember, and Mandeep mentioned this a little, the advertising business is very lucrative. It carries about 50% profit margins. So if you think about just the run rate they're at, that's $30 billion to the bottom line in the coming year. That's huge for Amazon. And that's really the backbone of what's driving profitable growth in North America, or you could say their retail business.
See, that was revenue that propelled my career, is that advertising revenue. But during the peak of my career, it was radio, TV, cable TV, maybe even a little bit on newspapers.
We still love the radio, people. We love the radio.
Exactly.
We're sticking to the radio.
Now it's $60 billion going on Amazon.
Amazing.
Wow.
Hey, Mandeep, before we let you guys go, to your point before, if we keep getting these kind of numbers, can we still call like Meta a growth company, even though it's now paying this dividend? Typically, you don't see that in the growthier companies. Like, can all things be true?
I mean, advertising is a very cyclical business. Right now, we are coming out of a trough and ad pricing environment is improving. And if you are an e-commerce company, there is nowhere else to go to acquire customers, given Meta has 4 billion users across its family of apps. So clearly, they get that mind share, and it's still a duopoly when it comes to digital ad spending. But I would say we are closer to saturation in terms of that digital ad growth than we were, a couple of years back. So not a lot of runway in terms of maintaining that 20% plus growth, but the next few quarters, I think they clearly will benefit from this ad pricing tailwind.
All right, guys, that's good.
Yeah, amazing. Guys, thanks a lot. Really appreciate it, Mandeep Singh and Poonam Goyal. Really great. I mean, I was shocked when I saw those numbers. Like, Apple didn't surprise me that much, but when I saw those numbers come through the terminal yesterday on the close, I was just totally floored.
Now, the thing with Apple, and we've talked to a couple experts today, including Gene Munster, is if I were an investor in Apple, I'd still be really concerned about China. I don't feel like I don't have a call of, hey, is it just the Chinese economy kind of slowing down, or is it Chinese people saying, I'm not buying Western stuff. I'm buying, it's more nationalistic. Now, that's a concern. Although IDC, the research firm, says Apple's got like its best market share ever. So I don't know how that's all playing out. So, but
competition is real. No matter which way you look at it, it's all about competition.
Yep.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Big tech earnings, and there's some themes coming across here in terms of AI, in terms of digital advertising that are pretty bullish, pretty constructive here. And we've been talking about it most of the morning here. We're going to bring in Angelo Zeno. He's a senior equity analyst and vice president of CFRA Research. He joins us via Zoom from New York. Angelo, I'd love to start with Apple, because for me, that's the most fascinating story coming out of big tech. I just don't know which way to go. And my big issue is China. Could you give us your sense about how you think China is as an opportunity and as a risk to the Apple story?
Yeah, and I think Apple, there's a huge bull-bear debate going on with that name right now. And when I think about Apple, yes, I mean, China is absolutely an issue right now. We're talking, a 13% decline in revenue in that region. When overall you actually did see, a broader industry growth in the December quarter there. Mid-single-digit decline on the constant currency basis. From that perspective, doesn't seem as bad. My guess is some of the guidance that they alluded to, even though they kind of blamed some of the tough comps from a year ago, probably also indicates that there is going to continue to be some weakness going on in China, probably through calendar 2024 at the very least. So, China becomes an issue for Apple, becomes a headwind. We do expect them to continue to lose share, but there is so much good stuff going outside of China, where we think kind of the story really plays out. But specifically in Asia grew 7% outside of China. And, you kind of look at areas that are going to continue to attribute, to that installed base growth. It's going to be areas like India and Indonesia over the next decade plus.
So, Angelo, what's it going to take for Apple to get credit for that? Because it feels like the straight-up China competition is truly what this company is trading on.
Yeah, I mean, it's going to take time first. I mean, but, when we think about the actual numbers here in terms of, not the top line, but more on the bottom line side of things and on the free cash flow side of things. And that's really what drives, we think, the valuation is in Apple. It's that free cash flow number. Despite the 5 billion or so less in expected revenue, the free cash flow number hasn't budged in terms of expectations here over the next year. And a big reason for that is because of all the kind of improvement they're doing on the margin side of things, the better mix on the services, but also the fact that margins are improving not only on the services side, but also on the product side of things. So that's really kind of helping to sustain, the actual free cash flow potential of this company. So, you have to be patient if you're an investor in this name and kind of believe in the whole compounding effect over time. But right now, it's tough to really kind of expect significant gains from a stock price perspective here over the next 3 to 6 months.
All right, we'll talk about significant gains from a stock price perspective. Meta Platforms up 20% today, all-time high. Over $200 billion of market cap was created just today in trading. So, and they're paying a dividend. They've been listening to me. Now the folks at Apple need to listen to me and up their dividend and give me a good 3% dividend yield. Talk to us about Meta here. Boy, it seems like everything's working there. What's your key takeaway?
Yeah, I think this is as good a quarter as an investor could have asked for. I mean, you're right. They initiated the dividend, but it implies less than a 1% dividend yield, right? I think it's more kind of the fact that they're just demonstrating to investors out there the conviction they have in that business and kind of some of the guidance that they provided out there. But listen, I think they're running on all cylinders. Grew the top line 25%. Actually, Q1 guide points to an acceleration of growth where we actually expected growth to start to decelerate sharply in the first half of 2024. You kind of look at how they're doing this. They're actually keeping operating expenses in check. And there's nothing better that Wall Street likes than kind of keeping the OpEx numbers in check in a world where AI is extremely expensive. And they continue to grow that top line by holding, by keeping it unchanged. So I think that's really the key as far as the Meta story is concerned, and you really do have to love it if you're an investor.
I mean, Paul does. He's been talking about it pretty much all day. But the idea that like the year of efficiency of 2023 will continue despite the information we got on Reality Labs in terms of how much they're losing and the capex going into it. When do I care about that when it comes to Meta?
As far as losses in Reality Labs and the potential revenue trajectory there, this is a long-term vision for the company. So they're making these investments for 5-10 years out from now. You're not going to get the immediate type of return that you're seeing on the AI side of things. I mean, AI has been absolutely phenomenal for Meta because it's apparent that advertisers are willing to kind of pay up for it because you're getting a higher ROI out there. So it makes a lot of sense. You're seeing most of the kind of the extra capex spend that's going into this company really on the AI side of things. But as far as those losses are concerned, that's gonna remain because you're not going to see that revenue trajectory really kind of play out for at least kind of another 3 to 5 years at your in the best case scenario.
So, Angelo, if investors are trafficking in the Metas of the world, the Googles, even Amazon, they have to have a call on digital advertising. What's your call on digital advertising?
So, entering the year, it was a high single-digit growth rate. So, it was pretty much going to be a similar growth rate that we saw in 2023, and our outlook for 2025 also kind of a high single-digit growth pace. I think how you're going to get that growth pace is going to be interesting. I mean, it looks like on the social media side of things, you're seeing some additional share gain taking place there relative to what you're seeing on the search side of things. Although Alphabet, to be fair, did not provide any type of guidance on their end, but it appears like that momentum continues to really be taking form on the social media side of things. We'll get some additional numbers next week when the Snaps and Pinterest of the world start reporting, but they're a much smaller player in this industry. But I think at the end of the day, the numbers look pretty good for us. There's probably upside to those assumptions that I provided to you because of some of that AI play and the fact that you're going to see an acceleration, away from those traditional sources to more of the digital side of things.
Hey, Angelo, taking a look at just the run that we've seen with some of these guys on some of the numbers, even NVIDIA at another record high today. What stock is most over their skis right now?
Oh, that's a great question. That's a really good question. As far as we're concerned, I'd say the names we like the most, the ones where we're absolute table pounders on, are Microsoft and NVIDIA. I think those names on any type of pullback, you just continue to load up and buy more of it. You have to love kind of the meta results here. But if there were a name I were to throw out there right now, it would probably be Meta. One, because of the type of move that you've seen in the stock today. I'd also say that the comps do get a little bit more difficult in the second half of this year. So there could be a scenario where, as those comps get a little bit more challenging, and they need to potentially spend a little bit more, that could kind of set up some potential disappointment later this year for the stock. So that's probably the name where maybe I would raise a little bit of an eyebrow among kind of the Mag 7 names right now.
Hey, Angelo, thanks a lot. Super appreciate it. Angelo Zeno, Vice President and Senior Equity Analyst at CFRA Research.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Got to be very, very encouraged by the strong labor numbers I got out today in terms of keeping this economy growing.
Yeah, but I still think that the idea of people still feel bad and then the number's still good and bridging that gap.
Yes.
And how that winds up playing out. We're still really early in 2024, but how that plays out, I think, really interesting.
Yeah, I guess that's a messaging story for the politicians out there. You got a GDP print better than expected. Everybody kind of has a job. Wages are going up. Inflation's coming down. But man.
But then you have to wonder: does that mean that we were going to wind up seeing the Fed not cut in May?
Yep.
And then does that keep conditions tighter? And then you have real rates actually increasing, et cetera, and then it actually does wind up hurting later. So the longer you push it off, then are we headed for something a lot harder? Yeah,
that's a great point. And that's kind of the discussion now. I guess it's all about May. Joni Biley joins us. She's the Chief Workforce Analyst at EmployBridge. Joins us on Zoom from Pompano Beach, Florida. What is it? What are we doing wrong here?
I don't want to be in Florida.
I'd like to be in Florida right now because we haven't seen the sun in like 2 weeks.
That's true. I don't know. I was in Florence, so
there we go, John.
If we're reassigning, I'll
she was
take
under
Italy.
the
You can take
Tuscan
Florida.
sun.
It's
true.
The Tuscan sun.
It's real pretty.
Joni, thanks so much for joining us here. I'd love to get your thoughts here and kind of what we saw on this jobs data print this morning. How do you kind of deal with it?
Well, definitely a big surprise, right? This morning, I don't think anyone predicted numbers that would be that high. I think maybe Goldman Sachs said it was going to be about 250,000, but never expected over 350,000 jobs created. And the reason I think it really is a surprise is we are still, seeing layoffs, not just in the big tech companies, but we're seeing more and more employers that are, cutting back. Now, there is some optimism about 2024. Certainly the companies that we work with at EmployBridge, I would say our hiring managers are cautiously optimistic, and they are saying that they are predicting, a better year of growth, of job growth in 2024 than 2023. But we're not seeing the robust growth that this report actually shows.
Well, let's talk about the one thing that confused me the most in the report, and that's average hourly work week goes down, which basically means maybe there's a demand problem, but wages go up. What does that mean?
Yeah, I was surprised by that number as well. So we are seeing people working a little bit less. The hours, worked per week did decline. And to your point, seeing wages go up so substantially, that was a surprise as well. We're not seeing as much wage movement. We track wage data as well. EmployBridge focuses primarily on the supply chain sector. So manufacturing, construction, drivers, transportation. And I will tell you, wages have been pretty flat. But when we see hours go down, it is the demand. The employers are not demanding, right, that workers are working overtime or, working really that full 40-hour work week. We're not near that level. So it definitely is a supply and demand issue. And again, I think something that would be concerning in this report. But there were some real bright spots in the report. Seeing professional and business services add, I believe it was 74,000 jobs. That was a big number. And we had seen some declines in that sector. I did go back and look at the revisions, and they have revised them upwards. So, those are more of the white collar professional jobs. And that definitely came back stronger than I think anyone predicted. We did see that also increase in the JOLTS report, the job opening report that came out earlier in the week. There was a big increase in the professional service sector job postings. So that is a good sign. That can mean some good things for 2024, that employers are, hiring more of those skilled positions.
Where are these people working, Joni? Are they coming back to the office, or is it 3 days a week, 4 days a week? I mean, we're like the last people to ask because we're in 5 days a week. So, but we're the normal people. What are they doing?
Yeah, so it is interesting. I think, one of the big concerns out there certainly is commercial real estate, because you can see in large cities that people are not coming back to work. They're not in the office buildings. Employers, and this again, mostly in the white collar, professional service jobs, and also in healthcare, we do see that there's opportunities to even work, remote or go to a hybrid schedule. And employees don't necessarily want to go back to the office. They like the flexibility. And I do have some concerns about that. I think there are a lot of benefits, right, of collaboration and working together and the social aspect. I have some big concerns about our younger generations that are just getting into the workplace. I have 2 children in college. I don't want them to have their first job and be working from home. They're going to miss out on so many great experiences and building those professional, communication skills. So I do have some concerns about it, but right now, for the most part, we're seeing hybrid models, remote work. Of course, that's very different in the trades and in supply chain, where people really have to be on site.
Yeah. Hey, Joni, thanks a lot. We really appreciate it. It's really fun to dissect all of this with you. Thank you so much for joining us, Joanne Bailey, Chief Workforce Analyst at EmployBridge, on that January jobs report. Just coming in a lot better than estimated.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Big tech still strong. High yields, maybe that hurts equities. Maybe you wind up having a Fed that's going to push out its rate cuts. That's going to be negative for equities, but the economy's strong. That should be good for equities. Do you guys get all that?
Yeah.
You got that? We're good to go now. Well, let's ask someone who knows more than us, James Demmert. He is Chief Investment Officer at Main Street Research. Hey, James, there's a lot of conflicting narratives here. What's the right one for you?
Good morning, Alix and Paul. I think the narrative is, again, investors get really caught up with Fed talk and you just look at the basic fundamentals here. We had a blowout jobs report. What does that tell us? Investors should know the economy is really resilient, right? I mean, that's really great data there this morning. And then I think at the same time, there's a concern that people are sort of caught up with the Fed has to keep cutting rates or has to start right away. And they're doing the right thing. I mean, they're lucky or smart that they've got the economy right where they want it. Who would have guessed? And so I think investors here should realize inflation's gone. The PCE, their favorite number, right? Less than 3, very close to where they want it to be. They don't need to cut, and you've got a resilient economy. What that means? New business cycle, new bull market. Keep it simple, investors. Don't overthink this. Earnings are what drives stocks in phase 1. That's where we are. Focus on earnings. Look at Meta, right? Look at Amazon. Look at Microsoft. Focus on earnings. Yes, higher rates can have an effect, negative effect on certain parts of the market if rates are higher for longer. We can talk more about that.
Yeah, I mean, I'm a former equity analyst, so I like to think earnings matter. I spent so much time trying to figure out where the earnings are going for some of these companies, build these monster models. What are you seeing so far, James? Again, today is all about the Fed, but again, we've had a ton of earnings, including some big tech last night. What do you see in some of the earnings that we've had so far?
Well, I think, one of the things investors should really focus on here is, what's driving these earnings. And one of the things I think that all of us should be excited about, you're already seeing it in tech earnings, is this effect of AI, right? That's going to be a tailwind for better productivity growth within companies. That should lead to higher stock prices over time. We're also, and I think this is really important, the meta numbers show us that as an equity analyst, you can appreciate this. We've gone through an era of efficiency, what we call it, otherwise known as cost cutting. And that cost cutting that a lot of companies have done over the last 18 months as they had inflation fears and market fears is now coming to be very rewarding. So I think, the cost cutting is obviously increasing margins. Meta, a really good example, but this going on across all sectors. And then you've got this sort of forward-looking productivity growth that we're really excited about. And that's why we think not just a new business cycle, but maybe a super cycle.
Ooh, a super cycle, a business super cycle. But hey, if we wind up having higher for longer now, or the economy actually is heating up and it's just kind of firing on all cylinders, doesn't that at some point, isn't that bad for equities?
Well, it could be, and it could be bad for the economy, and it could, bring the inflation boogeyman back. And that's why, again, investors should just get over their anticipation the Fed has to cut. I think the Fed's doing the right thing. They see this economy is strong. The last thing they want to do is cut. I think that's exactly where we'd end up, in that risk of, oh gosh, now it's, they've really juiced it by lowering rates when it was already pretty smoking hot. I think if the Fed sort of just sits back and does nothing, and let's face it, it might be that, everybody anticipates all these rate cuts, even the Fed does this year. It could be the economy is strong enough that they don't need to do any, and earnings then will drive stocks. So I think as long as the Fed keeps their hand on the tiller very carefully here, the economy can grow all by itself. The market is obviously pushing interest rates up today. Let the market do that. Keep the Fed out of the way, and I think the economy can be perfectly fine and not overheat.
James, I like big numbers as much as the next person, big round numbers, and you've got them in your research. You say over the next 10 years, the Dow Jones Industrials could cross 100,000, S&P 15,000, NASDAQ 50,000, all within the next 10 years or so. What's kind of the thesis that gets you those kind of numbers?
Yeah, Dow 100K, right?
Yep.
Some historic reference. I just finished my recent book, which is really about the market and what it does over time. And so, really what we're using is some data points. One is, if it is a new business cycle, which we believe it is, and if it's an AI-driven productivity growth type of cycle, what we're doing is we're attaching what would growth rates be for companies, and we can see earnings tripling over that 7 to 10 year period. That's usually as long as a business cycle lasts. 10 is a long time. I'd say 7 to 8, 9 years. We'll probably see earnings triple again with this AI tailwind. And that's sort of, you just do the math, right? The Dow goes to 100 grand. The S&P goes to 15. And the NASDAQ and the S&P probably, we'd say NASDAQ is 50,000 because that's the core of where that AI really is going to provide better earnings growth.
Whoa, that feels like a lot. What's your downside to that thesis? Like, what would be your risk to that?
Well, yeah, that's a good point. I mean, you can't just say, "Well, that's going to happen," and let's put it all in index fund and go home or come back in 10 years. I think there's a lot of risks in this, and one of them is, a lot of them are the obvious ones, right? If we fall into a significant recession, maybe because the Fed doesn't manage the interest rate cycle correctly, I think I'd give them the faith that that's not going to happen. But we also have, we have national debt that's a problem. Usually that's taken care of as it was in the 90s. We had such a big economy, we actually filled the debt back, that hole that the debt was creating. We filled it up by capital gains taxes on corporations. But you've got some stuff going on. And of course, we have this geopolitical risk. they can always turn the world upside down, which is why, in our case, we use risk management tools. I think it's very important, investors, things like stop loss orders are really important. Know how much equity exposure you need. Even if I say Dow 100K, I'm not saying investors you should be fully 100% in stocks. Understand your planning, how much risk you need to take, and only have enough equity exposure to get the return that you need, because there are those risks out there, and there's some ways to protect yourself.
What are some of the sectors that you think are interesting right here, James? A lot of folks, we got a lot of tech numbers over the last couple of days showing some pretty good strength there. What are some of the sectors you guys like?
Yeah,
Aside from tech.
I know, right? It's the elephant in the room. We are big fans of tech, and that's where we're overweighted. But gosh, if you look at just about every other sector of the market, and this is important, if you look at forward PE earnings, PEs, right? Usually PEs are not correct when you're starting a new business cycle, because the E is going to be bigger than people expect because of the earnings of the profit margins. So we look at valuation and we look at what sectors look good. Oh, it's not just tech. It's the financials. They're historically cheap. It is the industrial companies, historically cheap. A lot of this stuff is less than 15 times earnings. I think even, if you wanted to reach out into the REIT market, which has gotten crushed, or the small cap stocks, which are not acting well today, but they certainly would thrive over the next few years, I think investors should look there. So I think pretty much broadly across all sectors, you're going to see some better earnings from these low valuations. And again, you're going to have the AI tailwind. I mean, AI is going to have a tremendous effect on healthcare. And we're really excited about that as well. Low valuations in that sector.
All right, James, thanks a lot. That was a bullish view to a Friday. We appreciate it. James Demert, he's Chief Investment Officer at Main Street Research.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So we brought up University of Michigan sentiment. So this is a wonderful indicator. The inflation expectations also tend to move markets. We got the final read for January. Here's where they stacked up. University of Michigan sentiment up to 79. Current conditions lower than the last read, but at 81.9. Expectations much stronger actually at 77.1, and the one-year inflation expectations at 2.9. We've kind of been around that level for a while. What we want to do is bring you direct analysis from the person who knows these numbers, who did these numbers. And for that, we're joined with Joanne Shu, University of Michigan Surveys of Consumer Director. She joins us now. Joanne, always good to see you on a UMich day. What's your take from the numbers?
This is telling us that consumers are really starting to feel more assured that the inflation slowdown is going to continue. They had been reserving judgment for much of the fall of 2023, not really sure if the slowdown was going to persist or if inflation was going to come back. And at this point, they're feeling much more confident about it. And that is the main thing that's supporting this very large increase in sentiment that's been continuing on for 2 months now.
So, Joanne, the good sentiment numbers that you're talking about, I guess coincide, or let me ask you, to what extent do they coincide with the fact that, again, we got the non-farm payroll number came in today really strong. Kind of everybody who wants a job, has a job, that figures into your data as well, right?
Oh, absolutely. Consumers are by and large they're workers, and so they recognize that labor markets are strong, and that's also bearing out when we ask people about where they think their incomes are going in the year ahead. Their income expectations have strengthened over the last few months, and that's very much supporting strong consumer spending as well as their strong levels of sentiment.
Joanne, is there any divide between if the respondents identify as Democrat or Republican?
So there is typically a partisan gap in sentiment, and this month is no different. As it turns out, this 2-month increase, Republicans saw most of that gain in December and were not particularly changed in January. Independents as well as Democrats, they also saw a gain in December and continued to gain in January as well. For all three political groups, we're at the highest level of sentiment in a couple of years now.
So,
Interesting.
What is your sense? your survey work, I mean, is a recession still kind of on the table? Or if you take your data, you take the GDP print, you take the labor print, I'm not sure I can make a recession call here.
Consumers actually are quite split on what they think is going to happen with the economy going forward. There's still 48% of people who are expecting challenging, bad times with business conditions ahead, compared with 41% who expect good times ahead. Now, this isn't to say that we will be in a recession. Consumer sentiment numbers are about 7% below average. So they're nowhere close to the lows we were seeing last year. But the fact that we're on an upward trajectory, we're pretty much back to the same upward trajectory that we've been seeing since the all-time historic low from June 2022. And that definitely bodes well in terms of supporting GDP growth in the months ahead.
Here's what I find confusing, Joanne, because if you wind up having respondents feeling better about the economy, which would imply like, okay, maybe the Fed's going to cut rates so I can feel a little bit of pressure ease. But then because of that, we see an acceleration, which then increases GDP, which then means the Fed has to keep rates higher for longer and not cut. Is any of that track in the data and the conversations that you have?
I mean, I think this is, you ask an interesting question. And the reason this is interesting is because, the survey is not happening in a vacuum. Policymakers, including Fed policymakers, are reacting to lots of data, including ours. And when we are asking consumers what they think is happening now, they are folding in their own expectations for where Fed policy is going to go. We have the largest share expecting rate cuts since 2008. So consumers are absolutely expecting rate cuts in the year ahead. Now, of course, if all the strong indicators in the economy lead the Fed to to exercise more caution in their rate cuts, I think we'll see that play out in consumer expectations, especially as it passes through to consumer interest rates and credit conditions. But in this very moment, consumers are expecting much more strength in the economy than they were expecting 6 months ago, a year ago.
All right, Joanne, it's good to catch up with you. We'll get you for that preliminary February read, too. Joanne Chu, University of Michigan Surveys of Consumers Director. Paul, do you feel better than you did a month ago?
I do. I think I feel like I can really see the end in sight for the Fed, and that's all I need. That's really all I need. And I think if earnings are going to kind of stay in there relative to where the market's discounting, I think the market's set up for a pretty good move here. And then we've seen a lot of it. We've seen it. The question is, how much do we, see in November and December?
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.